Hi, it's Dennis. Welcome back. I want to talk to you today about the sale of a small business. I specifically want to talk to those incorporated small business owners that are pondering selling their business sometime in the next few years. Succession planning. How do I sell that business to minimize the tax consequences on the sale? Well, there's a couple of things that Revenue Canada looks at very closely when you're looking for that to utilize that $750,000 lifetime capital gains exemption for the sale of your small business shares. One of the items that they look at closely is whether or not your company was onside at the time of the sale. Onside means that they look at two types of assets that you own. There's active assets that are used, if you will, to make money for your business. And the second type of asset is a passive asset. Assets that aren't really used for making money for the primary type of business that you're involved in. So for example, let's say that you started out, your business was worth nothing. And today it's worth $750,000. And you're looking at selling your business, all of the shares, to somebody else. And in your bank account of that company, you've accumulated, let's say, some $300,000 of cash. Let's say on a typical basis that you need about $50,000 of that cash sort of month in, of money that sort of flows in and out of the account on a regular basis. But the other $250,000 that you've accumulated over time is just sitting there, earning a little bit of interest, but not at all involved in the active part of your business. Revenue Canada would look at that and at the time of the sale would say, you know what, more than 10% of the assets of the business. Remember, we had a $750,000 value. You have $250,000 of extra money in the bank account. They're going to say, look, you've got 25%, or sorry, 30%, 33% of the value of your business is in cash. So as a result, we think that we don't consider your business to be onside. So we're going to disallow the capital gains, that $750,000 capital gains exemption that you thought you were going to qualify for. So 2 years, in order to avoid that kind of a bad outcome, you have to make sure that 2 years prior to the sale of your business, as a minimum, make sure that there are less than 10% of passive assets inside your company. Cash is a classic example, but another one that might not be as obvious is, let's say, real estate. Let's say you own the building that you operate your business in, but at the same time, you only utilize about 25% for your work, but you rent out the other 75% of the business to others for rental purposes. So it's rental income. Well, guess what? If the value of that building is worth more than 10%, if you will, after you subtract out the portion you're using for your business, then the building is making your company offside. So that also might cause you to miss out on the lifetime capital gains exemption. What I'm trying to do is point out here that there are pitfalls that you need to be aware of. My job is to identify those pitfalls, but then we need to engage accountants and lawyers to make sure that the sale of your business is done correctly. And that not only at the time of the sale, but some 24 months prior, that everything's in line so Revenue Canada doesn't sort of hit you with a surprise after the deal is done. Thanks for listening and have a great day.